in terms of private credit, to get back to your question, I think it's like, I don't know the stat, but like, didn't the BIS or somebody come out and say like only 40% of them have positive free cash flow of like all the private credit loans out there? And so like, I think under the hood, the general economy is not super strong. And if you talk about like the fact that we have a 7% or 6% of GDP deficit and an all-timer CapEx boom, like, what happens if that dissipates, right? So I think that's what we got to start thinking about, is the other side of this. So rolling is starting to happen, and it's very obvious, but it's just like this last leg of the boom, which was the hyperscalers giving all their free cash flow to memory companies, right? And I don't know if you see that chart.
The dislocation and the imbalances are just absolutely enormous. I think that's the biggest problem, or the biggest part of it, that maybe most people don't really truly appreciate. As you said, I mean, it sets up tremendous macroeconomic risk on top of everything else. But just to go back to private credit for just a second. Yeah, Oracle's not going out of business. Oracle's going to be fine. Their stock price may not be fine. The hyperscalers aren't necessarily going to be in big trouble either. So the issue really is, what information can we get about the state of the marketplace from how the market is treating those particular issues? Do you see them in the private credit space as being leading indicators in the same way you could kind of look at them in the stock market? Or is there more nuance there too, where we should look at private credit as far as different segments? Is it got to the point where we can look at it as sort of a global whole, where private credit is an industry? And then of course there's the potential contagion and spill over into leveraged loans and then CLOs and all the products that go beyond it. But are we to that point yet where private credit is a private credit thing, or is it still just kind of bits and pieces?
I mean, I guess I think non-financial credit's like 80 trillion, right? And half of it is the government. So of the private sector, not private credit, but private sector debt, it's about 5% to 8%. I don't know the exact number, but and so the question is the increment, right? So I think it's been the incremental driver of a lot of this credit expansion. And let's remember what private credit is. It's the same jokers who were underwriting the GFC bad paper, but after the GFC, there was a bunch of regulations that came down. And so private credit became, or shadow bank, whatever you want to call it, was a regulatory arbitrage. So the banks,
they went
warehouse
from Wachovia and Countrywide to BlackRock and Guggenheim. That's the same people.
Well, the BlackRock CEO of the credit fund exited stage right last week. And then like a traditional sneaky Wall Street guy, they didn't release the story until after the close on Friday. It's like, whenever you release something after the close on Friday, it's never good, dude.
Well, I mean, the whole thing has always been there's absolutely nothing wrong with private credit, and all of a sudden we're starting to see executives getting let go left and right, and the messaging is shifting too, which is another thing. The psychology on private credit to me is a big thing it seems to be changing. Like you said before, now we have a CDS market on SpaceX that shows up a couple of days after it goes public. The entire attitude is definitely changing.
Yeah, and I think also you got to remember that private credit is also like this. I think it's actually better, to be honest, because I don't think bank runs are a good thing. If we think back about SVB, I'm not an interventionist. I don't like the Fed. I don't like the strong hand of the government. But at the same time, most people aren't trying to think about that, what they call money is not actually uniform, right? It's a claim on a commercial bank's assets, and each bank has their own assets, but we all accept it as the same thing, right? And so, screwing over the average person, making them have to pay attention to bank balance sheets and what's going on is not fair. So, but
you're making the argument for elasticity. Elasticity doesn't have to be public, but elasticity is a very, very good thing.
Yeah. And so, the withdrawals as a percentage of NAV go up every quarter for the last couple quarters, and they get gated at 5% of NAV. So it's we're in a slow motion shadow bank run, basically, is what it seems like. Basically, we got to get to the point where maybe commercial real estate is there, right? Commercial real estate is on year 4 of getting upended by Jay Powell, not deciding to raise rates when he should have in 21, and then being like, oh, I'm going to catch up and just do consecutive 75s. And I hear that a lot of those assets are starting to go at discounted prices and distress, and forget about the office part because that could be secular. I don't know. But
same thing for private credit too, right, Ben? Getting a lot of reports about secondary market sales and how a lot of brokers are getting involved in secondary markets and ramping up their capacity, which on the one hand, that's good if you're a bargain hunter with a lot of liquidity. and you're looking for cheap debt. On the other hand, though, that tells you that there's a lot of liquidity. Like you said, the liquidity pressure is starting to get to be substantial to the point where some of these funds are thinking, my credit line with JP Morgan is getting increasingly difficult. They want more collateral every time. It's too expensive. I'm going to need to start selling. You're starting to see a little bit more of the selling pressure show up in private credit too.
Yeah, I think that's right. And I think like the private credit thing is like, so the thing about it is it lacks transparency. I think it's like people don't really know what you own and there's no like flow through down to the level. And I think that's where the disconnect was, right? Like every major investment or like, family office, pension, they don't like the mark to market. Nobody likes the mark to market, right? Mark to market is messy. It's up and it's down. It's nicer to just get your like statement, be like, we're up 1% this month, or 2.5%, 3% for the quarter. We're good. And like it's like, speaking of BlackRock, I mean, these guys did 2 funds that were marked at 100 and then they marked to 0. I mean, how is that not criminal? Like if things aren't going well in your investment portfolio, if you're really close to the things you invested in, like you don't just be like, I mean, even Enron took a while to go down, right? Like.
Yeah. The fraud of all frauds. The only argument that they have is fraud. Like, hey, this loan was fine one day, then the next day we got an email from our auditor that said, there's 2 columns on a spreadsheet and one of them is fake, and you've been following the fake one. That's the only defensible argument.
Which is what the big lender, the operation that went down in September was, right? And so that was kind of the defenders, like, hey, these are bad actors. This isn't a bigger problem. And that could be, right? Like, there are bad actors, but like in a world.
Except for the fact that nobody's buying that story. I mean, if it was just a couple of bad actors, to me, we wouldn't be seeing quarter after quarter after quarter of institutional investors trying to get their money out of these funds. Because the institutional investors are saying, look, these funds, they didn't do a good job underwriting all these loans. We all know that. I mean, it's the bubble psychology and bubble cycles. On the way up, nobody cares. You just do the deal just to get it done. You don't look at any of the details. You don't look at the collateral to see if it's triple, quadruple pledge. You don't care about any of that stuff. I think that's why First Brands hit so hard, is because everybody knew the behavior was there. And when it finally became public, it was like, oh shit, guess what? Now we got to look at everybody and everything. And it's just easier to yank my money out. But yeah, I mean, that's the point, is that everything that has come out, you're exactly right, Ben. Everything that comes out plays into that mistrust rather than allaying people's fears and creating more trust and saying, that was just First Brands. It was just Tricolor. It was a couple of bad apples, but look over here and everything else is fine. It's almost like everything that comes out confirms people's worst fears.
Yeah, I mean, I think these things move in cycles too, right? Where there's like, no one listens. Like you try and warn, everyone's like, you're crazy. And then like everyone who could see something like a change in how things are, whether it's going to be like this kid who has a $25 billion fund who saw this whole AI thing and the open AI guy, he saw it and now he's done well. Now, guys like us who saw the GFC, well, there's years when no one wanted to listen at all, right? So there's like, you've got to kind of look under the hood on these big turns, because turning around the Titanic is much different than turning around a speedboat, right? So I think that like the private credit thing has been a big driver of investment. And like the biggest driver of credit growth right now is the hyperscalers, right? And so and I created this website actually that's actually pretty detailed using an LLM. And I have a countdown days till negative free cash flow for the hyperscalers, and we're like 50 days away, right? And we'll see how earnings come out this week, and it could be even closer because Google was worse than I was thinking it was going to be. And so like we could be, less than a month to 2 months and so where does the capital come to meet those expectations of CapEx in 2027 and 2028 that are underlying a lot of these estimates? And I think that's what the market's doing right now. They're like, I'm not sure about my 2028 estimate here. And so, basically we got to pull it back. But again, I go back to the 1840s railway thing. It peaked in like 2 years before it really rolled over. And so like the CapEx kept going. And then once they finally cut the CapEx, that was like the sploosh. But the market peak was 18 months before that. So maybe that's the analogy, is that we are at a market peak we just were at the peak of the thing. And then what I would say is, Jeff, you can probably back me up here. When the tide goes out, you have a situation where a lot of bad players get like exposed, right? Like when the liquidity's gone, and I don't know, let me ask you this, Jeff. We have a situation where the global bond market is just not great, right? Like to say the least. And if credit spread's starting to rise, like how long can this last with like equities at insanely tight risk premiums and or valuations and credit spreads rising and sovereign rates rising? And now we got a Fed guy who's going to come in and be a tough guy and like show everyone what he's worth. I don't know. There's going to be a point here where like it's like, okay, that's enough.
There is, that's always the question is, what is it? What is the final straw that breaks everyone's back? And you're right. These things go on longer than you think they can. I mean, it's still the old line from Keynes, the markets can stay insane longer than you can stay solvent.